Hi, everyone. Welcome to our Thursday webinar. I'm Kathy Fettke, co-founder and co-CEO of Real Wealth Network. And we are going back to basics today, the basics of buy and hold real estate investing, and whether it still makes sense today or if it's time to sell everything or buy like crazy. Where are we in the cycle? And with that, I think it's really important to go back to basics because we've been super spoiled over the last 10 years, specifically exactly 10 years ago when real estate took a nosedive and people were able to buy properties for as low as 10% of value and get massive cash flow. And it was a very abnormal market. So a lot of people are wondering, wow, are we going to go through that again 10 years later? Should I wait and buy a property for 10% of market value? So we're going to talk a little bit about that today. But more importantly, I want to get back to basics because I do believe that was a blip. If I'm wrong, then, I don't think I'm going to be wrong, but if I am, then you just need to do your own due diligence, take the data that I share with you today and come up with your own conclusion. I'm sharing my research and my thoughts with you, but by no means do I have a crystal ball that really works. I just am in the industry so much and hear so many economists. I go to conferences and seminars and hear lead economists pretty much on a weekly basis. So I gather all of that, I boil it down, and hopefully try to simplify it for you so you can make the right decisions moving forward. So once again, welcome for anyone who's joining us now. I'm Kathy Fettke, co-founder and co-CEO of Real Wealth Network. Somehow I've remained passionate about this topic for decades. I don't know how, sometimes I wonder, but I just think it's really exciting to be able to have a plan in place, to have hope, to know that you can retire someday with enough cash flow, maybe sooner than later, knowing that you can enjoy your retirement years and like I said, maybe even be able to do it sooner than you expected through real estate, through cash flow that you can get from real estate, through the leverage, through all the things I'm going to talk about today. So welcome. Before we get started, I do want to share with you that we have upcoming webinars. We've changed our format. You probably know that. Tuesdays, we do a market overview, and on Thursdays, we show specific available properties. What we had been doing was combining those in one webinar, but a lot of people said, hey, I already saw the market overview. I'm already sold on Florida or Texas or Detroit or wherever, and that you just want to see properties. So we split it up. And on Tuesdays, you get to learn about the market and decide which markets really excite you and where you see the most potential. And then on Thursdays, you get to see available properties to sort of streamline that whole process. So next Tuesday will be Jacksonville, Ocala, and Punta Gorda in Florida. And that will be a market overview. And then Thursday, you'll be able to see specific properties. And then the following week will be Detroit, Michigan, and you'll find out about what's going on there. I do recommend doing both because markets change. They change all the time. You may want to know what's new and exciting in Detroit or Jacksonville, and you'll learn that on Tuesday. And then again on Thursday, you'll get a chance to see available properties. And as you probably know, those properties sell really, really quickly. So if you see something on those webinars that you love, a property that you must have, you want to really move quickly because there's a lot of investors in our network, over 42,000 at this point, and inventory's been not as abundant. So when you see a deal you love, you really want to move quickly, or just know that our teams can hopefully find you something very similar if you can't get that one. All right, and of course you do need to have a strategy session with one of our investment counselors before you get on those Thursday webinars, so make sure you do that, and there'll be instructions to do so when you join at Real Wealth Network, which I imagine you already have because you are on this webinar. And then our next live event, I will be at both of them, Saturday, July 13th in San Mateo. That feels like a world away, but it's coming soon. And then Sunday, July 14th in LA. And then Saturday, August 10th in Cleveland. We've been doing more events on the eastern side of the US, and it seems to be real popular with our members because we have so many of you on the East Coast, and getting to Cleveland may be a little easier than getting to San Mateo or Los Angeles. Plus, you might want to see the properties in Cleveland or Detroit or Cincinnati or Indianapolis or wherever, on that side of the world while you're in town. So we've been doing these about every 6 months, and the next one is Saturday, August 10th. We're all going to be there, and as many of our affiliates that can will come out for that. We know at least 10 are coming. One day you get to hear from 10 different affiliates. So again, a lot of our members enjoy that, because if they're in the middle of a 1031 exchange and they just want to learn everything all in one day, that happens on the 10th. Okay, now here's a disclaimer. You've heard it before, but I am going to go over it again, because it's so important to understand that any investment has risk. All investments have risk. There's no certain sure thing in this world except death and taxes, right? So just know that if your money's in the stock market, if your money's in stocks and bonds, if you're a lender, if you own real estate, if you're in syndications, there's always risk. And you need to understand that risk and then decide which risk you can handle and which one you can't. And also how to eliminate as much of that risk as possible by doing your own due diligence and your homework and so forth. And that homework includes always getting an inspection on any property you buy. I usually get several inspections because I want to know what's going on with the property before I buy it. And then get an appraisal, even if you're paying cash. These things are very important. Unless you're just a real estate whiz or a contractor and you don't need that, if you know how to value the property and you know how to walk through a property and see what's going on with it, then maybe you don't need those things. But otherwise, absolutely get that third party to verify what it is that you're buying. Always run everything by your CPA, by your attorney to make sure, but mostly your CPA, because not everybody has an attorney. Your CPA will be able to tell you if whatever investment it is you're investing in is right for you, whether it's property, whether it's investing in a syndication. There are tax implications for everyone, and they're different for everyone. So don't let anybody tell you what kind of tax benefit or implication you'll have. The only person who should be telling you that should be your CPA, who knows your situation. Okay, so again, it's your responsibility to do your own due diligence. At Real Wealth Network, we have created relationships with affiliates across the country who offer, they're real estate investors. They buy properties, they fix them up to our standards. They have property management, whether it's their own or others, in place. They have a great track record with our members, but that doesn't mean that one of them might just, one day wake up and lose their mind or we don't know what happens. People change. So, even though somebody's got a great track record, it doesn't mean you don't do your due diligence on it. You've got to still do that. So that the affiliates that we work with, they run their own companies. We just are kind of like Yelp, where we have great reviews. But that doesn't mean like a restaurant, someone else might love it and someone else goes and they don't love it. It's what these affiliates have a great track record with our members, but they are separate companies. Okay, so let's talk about the benefits of buy and hold real estate. Okay, I mean, lots of money can be made flipping, lots of money can be made in house hacking and the BRRRR model and all that. What we're going to talk about today is how to build long-term wealth and why that after 20 years is still so exciting to me. So, and I think to a lot of our members, clearly. And the first one is leverage. I'm going to go into that a lot. Tax benefits are incredible. Values increase over time. That increases generational wealth. And then you've got asset protection on top of it and cash flow. So there are so many benefits of buy and hold. Let's go into it a little bit deeper. So this is a little comparison that I made. It is super high level and things don't always go as planned, right? So I just gave this model to give it a comparison that if you were Joe and you had $100,000 and you decided to buy gold, so many people ask us, should I buy gold? And Rich and I say, yeah, buy some gold, buy a little gold, because if the whole world crashes and the dollar crashes, gold usually goes up in value. So why not have some, it's certainly not something that's going to necessarily make you rich overnight. There's no cash flow from it and so forth, but still we recommend it. So Joe goes out and buys $100,000 worth of gold and he's got $100,000 value. Now, Mary says, I want to be in the stock market. She takes her $100,000 and she buys on margin, let's say 50% margin, and she's able to get $200,000 worth of stock. So she's using leverage and feels pretty good about herself. Pat, I used Pat because we don't know if Pat's male or female. Pat takes his $100,000 to buy real estate. So basically, gets $400,000 worth of real estate because Pat only has to put $25,000 down. I would say $20,000 down and have 4 properties and have $20,000 remaining for reserves and so forth. So Pat uses the $100,000 to buy 4 properties with loans and now has $400,000 worth of property. Now let's just fast forward 15 years and say that all of these had 5% increase in value every year during 15 years. Now, the chances of that happening are like non-existent, but I still just want to compare so you can see what would happen if 15 years from now, there was a 5% gain on all of these investments. Well, Joe's gold is worth double now. So he's super stoked. He's like, look at me. I'm a great investor. I doubled my money. I have $107,000 profit. And Mary, well, Mary's stock is worth $415,000 in 15 years at that 5% annual growth rate. She pays back the margin, $215,000 profit, and she feels smarter than Joe. And then you've got Pat. Pat's property is worth $831,000 in 15 years. Wow. And that's because of leverage, because Pat was able to buy more with less down and paid off the loan down. And look at that. Pat is feeling great. Big profit just on that 5% gain on the property. But there's more to it. Pat gets more bonuses, and that comes in the form of cash flow. The properties were rented, producing income after expenses, which equals cash flow. 8% of that $100,000 that Pat initially put into the properties at 8% made an additional $140,000 in cash flow in those 15 years that you need to add on to that amount that came from appreciation, that 5% appreciation. And if Pat put all that cash flow towards paying off the loan instead of pocketing it, that $140,000, all of those properties, all 4 could be paid off in that 15-year period. So we have $731,000 in equity plus, I'm talking about in 15 years, Pat would have $731,000 in equity plus the cash flow from those properties, which would be at least $30,000 of rental income for life. I would say it would be even higher than that, but I'm using today's dollars. I think it's important that we recognize that we're going to face inflation, no doubt about it, and rents will be probably double what they are today in 15 years. So that rental income is going to be more like $60,000 at that time, but $60,000 is going to feel like $30,000 because everything's going to be more expensive because of inflation. So just know that it's probably $60,000 of rental income coming in for life and going up every year. All right, but that's not all. That's not all. Pat gets more deductions, tax breaks from owning this real estate. Pat can deduct mortgage interest, property taxes, insurance, maintenance, repairs, professional fees, education, and even travel to the properties. Pat can even write off travel to Real Wealth Network events or trainings. It's incredible what you can write off. Now, I am not a CPA. And as I said earlier, make sure you run everything by your CPA to make sure that this is indeed true for you, that you can take these deductions. You can also take depreciation. These things all passed the last tax law, did not change. Pat can write off his homes as if it were worth nothing in 27.5 years. It's called depreciation, which means that you take 80% of the value of the property. Well, it depends. You just basically have to take the structure. You can't depreciate land. Land doesn't go down in value, but the IRS says, hey, your property does. So you take the the value of the property, which in the markets that we're in the land isn't worth much. It's the property that's worth more. We say it's about 80%. Talk to your CPA to make sure you understand the difference between the land and the structure value. But you take the structure and you divide it by 27.5 years. So $100,000 times 0.8, 80%. $80,000 divided by those 27 years is about a $3,000 annual deduction, or $180,000 in deductions over that 15-year period. So you could trump your taxes. And as you probably remember during the debates, when Clinton said this guy pays no taxes, and he said, yeah, that makes me smart. Now, a lot of people might not like this philosophy and might think we should all be paying our fair share of taxes. But you know what? Everyone says that until they get the tax break. Because if you're the one who suddenly doesn't have to pay the taxes, you might change your mind on all that, and then just donate your money to whomever you would like to donate it to. Okay. Asset protection is another thing that Pat gets. This is pretty awesome. You can put your property into an LLC, limited liability company, and it provides personal asset protection. It's a separate entity from you. You could be the manager. It's a pass-through taxation, so there's kind of no really difference, except that your LLC is a business. It's a company, so expenses can be, spent from this LLC, which then can be deducted. So, and there's less regulation. So most investors put their properties in an LLC and provide that asset protection. So, because so many people are worried about owning property and, being a target, but if you have it in an LLC, you're less of a target. And then you also have the incredible option of insurance. Umbrella insurance on your property is another form of asset protection. So as I mentioned earlier, these are just a lot of the things and the benefits that we have. We already kind of talked about the property possibly going up 5% every year. And is that something we can count on? Of course not. We have no idea what the appreciation is going to be. But when you look at this median sales price of houses sold for the U.S., look at from 1965. These lines in here are recessions. So you can see not every recession affects real estate that much. We had oil issues in the 70s, caused a big recession, but not so much in real estate. And then the 80s, we had the S&L crisis. Well, look at that. Prices still went up, down a little bit, but then bam, went straight up again. So if you bought a property in 1975 and held it till 1985, look at that. You made a good amount of money. Even if you bought before the recession and held it to this recession, well, that's pretty good. You still did pretty well. And if you bought it in this, let's say you bought it at the peak here and then prices drop, but you held it 10 years, you still made money. Even if you bought it in another down market, bought it at the peak, held it for 10 years and sold it in a down market, look at, you still made money. Now we know that the biggest decline in home values happened just 10 years ago. So what would have happened if you bought at the peak right before that crash and held on to it for 10 years? Maybe you didn't make a lot of money, but you got your money back. And if you kept holding it, then you would be okay. So nobody wants to buy at the peak, but I think it's just important to understand that over time, housing has gone up in value if you hold it. And then if you want to pass it on, a lot of people don't realize that when you pass on, then the property, at least today's tax law allows this, that if you pass away and it's in a trust, maybe even if it's not in a trust, talk to your trust attorney about this, but the people who inherit your property, well, they inherit it with a stepped up value. They inherit it at a stepped up market value the day they inherit it. So let's say you bought the property for $100,000. It ends up being worth $200,000. It's a $100,000 gain that you would pay if you sold it. But if your children or your heirs inherit it, the property steps up to the value of $200,000 and they don't have to pay taxes. So, I mean, there are certainly taxes to look into, but it's a really high amount. That was changed with the Trump tax law that I think it's millions that you have to inherit before you pay. Again, talk to an expert about that. And living trusts, assets that have been conveyed into a revocable living trust, do get a step-up basis when they're distributed to the beneficiaries after the passing of the grantor. So again, a wonderful way to take care of your family when it's time for you to go. They can then enjoy the cash flow from your properties without having to pay the gain. All right, so if that's not exciting enough, then just imagine this. Imagine owning a rental home free and clear that pays you $1,000 a month after all expenses. Wouldn't that be nice? You've just got this little golden goose that pays you $1,000 a month because someone's living there and loves it and is renting your home, has made it their home. So imagine having 10 of those. Now you would have $10,000 a month after all expenses, and that would not be the worst way to retire. You might be wondering, well, how on earth am I going to manage 10 properties? Well, that's what property managers are for. They take 8% for that work. But like I said, if you could still be making that $1,000 after paying the property manager on 10 properties, that seems like a fairly secure way to secure your retirement. You might be wondering, well, how on earth am I going to own 10 homes free and clear? Well, it starts with one. It starts with one. $20,000 down can buy you a $100,000 property. And so if you were to buy 10 of them, you would need $200,000 to $250,000. So you do need money, but it can be done. Maybe you do it once a year, just saving your money. Maybe you are able to refi your home and take that cash out and get this going, or you cash out some stocks or whatever. But it's just really exciting to understand that with about $200,000 or $250,000, you can acquire 10 homes because Fannie and Freddie conventional finance will allow you to get 10 investor loans each per person. If you qualify, if you're both working, you and your spouse, you can each qualify for 10 loans on investment property. So if you bought 10 homes with $20,000 down and your target was about $300 net cash flow, then you would have about you'd have $3,000 a month cash flow. If your target was $300 cash flow per house, you'd have $3,000 every month, or $36,000 at the end of the year. Remember, you've got an $80,000 loan if it's again a $100,000 house, you have an $80,000 loan, you've got $36,000 a year cash flow. You could take all of that cash flow and pay off this first house, in about a little over 2 years. Now you've got more cash flow because this loan's paid off. You can apply all the cash flow to paying off that and that and that, and that's how you are able to, have a portfolio of 10 homes in 10 years, more like 15 years. So what are the risks? Well, there's always risks. As I said, there is risk of recession. There's risk of people losing their jobs. There's risk of declining property values. As I said, declining rents. Tenants are a risk, lawsuits and so forth, or you lose your job. So these are all legitimate risks. But as I showed earlier, if you're able to hold the property, historically, you can hold it right through the recession and values pop right back, even after one of the worst housing recessions ever. Those values can come back if you buy right, if you buy in the path of progress, where people are going in desirable areas. You don't want to buy an area that's dying and where jobs are leaving. Tenants, like I said, you can mitigate risk by buying property that are more landlord-friendly areas as opposed to tenant-friendly. Would you buy rental property in Portland today? If you haven't heard, they just passed a very, very strict rent control law. So that wouldn't be my first choice, and either would California because of the tenant laws. So I would go to places where the landlord is respected for providing that rental housing, and for the great service of providing rental housing. There are laws to protect, and tenants need to pay because certain states understand that that the landlords are at risk and are taking on mortgages and need those mortgages paid, and people can't live in their houses for free. So you can avoid some of the hassles by investing in the right states that have the right laws to protect you, and to have the right asset protection with LLCs and with the right insurance. And lawsuits, people have a lot of fear about lawsuits, but I got to tell you, I don't think I've heard of one lawsuit. With the 42,000 members that we have and the 20 years I've been doing this, I honestly can't think of one lawsuit. I had one member I was really nervous about because he bought an older property, and the baby in that house had some lead poisoning, and I thought, oh my gosh, maybe the baby ate wallpaper or paint or something, and I thought this is going to be the first lawsuit. Let's see how it goes. Even so, he wasn't sued. I truly hope the baby's okay, but it turns out that the father worked in an industry where there might have been lead on his clothing, and it may have had nothing to do with the property. My point being that people are so afraid of lawsuits. I haven't seen any. It doesn't mean that they don't exist and won't happen. But if you're adequately protected, you've got the LLC, you've got the insurance, then that really mitigates the risk there. And if you lose your job, well, that's unfortunate, but if you've got enough reserves set aside for your properties, well, that could actually be a benefit because you've got cash flow. You just change your plan, which your plan might have originally been to take all the cash flow and pay off the loans, but you decide, nah, I need to live off it for now. So it's actually a benefit to have the property. Okay, so we might be wondering, well, is it too late? Are we too late in the cycle? Did I miss it? Have we peaked out in pricing? So here is a webinar I was on just a few days ago by Metro Study and Zonda. And this was a really interesting slide that I snagged from them. Like I said, I do these webinars all the time because I really, really want to understand. I feel tremendous responsibility for understanding what's going on out there. Not that I can predict everything, but we can predict a lot of things. So here's a slide to show the red being oversupplied real estate and the blue being undersupplied. Now, here we are. If we go back to 2004 or 5, we were undersupplied for demand, but this is when easy loans were being given out and anybody could get a house. So yeah, we were undersupplied for that kind of demand because anybody could get a loan and buy a house. Well, when that didn't work out so well, then bam, we had this massive recession, and all of a sudden we had way too much supply in the market. Of course, we know what happens with that. Then prices go down when you have too much supply. Well, that supply got eaten up. Smart investors went in and bought for cheap, and then prices started to go up, 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 up. And then suddenly we got into a situation where builders didn't build because there was too much supply, but the population grew, and we have a huge generation, the millennials, who are now out of college and forming households, so massive household formation, but we haven't built new homes. So now we are severely undersupplied. So look at the difference in these charts, and here we are right now. So according to Metro Study, they are seeing that the undersupply is going to last a few years, and then right around 2021, maybe there'll be more properties on the market, but they don't see equilibrium until 2024 in terms of supply and demand, which we might have a good 5 years ahead of us with not enough property to meet demand, which means that prices could continue to rise or at least hold steady. So in other words, if you're waiting for a recession, you're going to be waiting a really long time, at least according to Metro Study. They think not until 2025 when there might be more supply. All right. But there are some markets that are top heavy, and this shows annual closings are the red and housing inventories the gray. You could see over here there's more housing inventory on the high end and not closing. So we have oversupply in the high end, and you probably have heard me say this or heard lots of people say it. It's because builders can't seem to figure out how to build affordable housing, although we're doing it on a new project we're really excited about. I can't actually talk about it on this webinar, but if you make sure that you fill out the investor form on our website, I could tell you about it, because anytime you can bring in affordable housing, it's desperately needed. It will sell quickly. But on the high end, a lot of builders haven't figured out how to buy land cheap enough, how to construct it cheap enough. Labor costs have gone up, material costs have gone up, permit fees have gone up. So all they can do is provide the high end to try to make any kind of profit. Unfortunately, they may have overbuilt. So more inventory, less demand. But look over here, more closings than what's on the market. So we're going to see strong demand on the lower end for a while. And the key takeaways from this webinar yesterday was that the national housing market will continue to be significantly undersupplied in 2019. And like I said, for the next 5 years or so, according to Metro Study, the national housing market will become increasingly overvalued as a result of it. However, the risk of a home price collapse is small in most markets due to the undersupply. So even if we did have a recession and there was a massive loss of jobs, it would almost be good for the housing market because there would be less demand and maybe prices would come down. So, but not there certainly isn't a housing crash predicted in the future due to low supply. We have the recent drop in mortgage rates, which may reverse as economic pressures combine with the impact of debt and higher risk. But for now, we have low interest rates. So it's a really awesome opportunity to acquire properties, lock in that low rate. Rents are expected to rise, prices are expected to rise, but you're locked in with low rates. And rates just keep going down. So take advantage while you can, because they may go up. I don't expect they'll go up much, but they've certainly gone down recently, and it's a good time to either refinance or get some more loans. So overall, they think we're in the middle of the 8th inning with a mild to moderate price correction predicted. And then we've got these millennials who are saddled with, I think I've got a slide for that. I'll talk about that in a minute. So here's the slide on interest rates. I mean, look at that. We are down again down here. Historic lows on interest rates, and a really good time to lock it in because historically it would be a bit higher. Let's say you get a 30-year fixed rate mortgage, but you say, hey, I'm 50 and wasn't planning on retiring at 80. I would like to retire sooner than that. So a 30-year fixed, why would I do that? Well, that's like I said earlier, a 30-year fixed is a really low payment. You have higher cash flow. If you want, you can just take all that cash flow and pay off the loan. But if you run into tough times, you have a lower payment that you're locked into. And so I don't necessarily recommend the 15-year for that reason, unless you're certain you won't have any trouble paying it. But if you get the 30-year, you can still pay it off in 15 years by making an extra on a $100,000 home, just making an extra $1,000 payment a year towards principal. You'll pay it off in 22 years. If you pay an extra $2,500 per year, you can pay it off in 17 years. And if you pay an extra $5,000 per year, you could pay off that 30-year mortgage in 12 years, which is basically what I was saying. If you take all the cash flow from your properties and put it towards one loan, you can pay off that whole portfolio in 15 years or less. I just did a show on it on the Real Wealth Show. Definitely check it out with one of our members. They're following this plan and it's worked out really well. Very inspiring. So again, power of leverage. Okay. So I think that's it on the slides. I can take questions now. What metros do you recommend? Very, very good question. I've got a good slide for that, but I'll have to do I'm going to do another webinar on that because I have a whole lot of data on which markets. But if you just go to our website, realwealthnetwork.com, the markets that are listed are the ones that we like. We are seeing the most growth going towards the southeast. So Florida, Texas, Georgia. We are also seeing incredible deals in the northeast. So those markets are still cheap and high cash flow. They're recovering, and it's great if you're really wanting high cash flow, you'd go to the northeast. If you're wanting okay cash flow but you want more growth, you'd go to the southeast. And again, just check out our website under the single family rental tab or the invest tab. Could you discuss HELOC for real estate investments, good idea or bad idea? So I'm assuming what you mean is getting a home equity line of credit on your home and using that to buy real estate. So just It all depends on the kind of loan that you're getting. If you're getting an adjustable rate HELOC, then you have to be aware that that could go up. So I'm not a huge fan of that. It's kind of like having a credit card, but maybe rates will stay low and that won't be a problem. However, if you can get a fixed rate, I much prefer that because rates are low. You might even just want to do a cash out refi unless you have an awesome 2% rate on your home that you got a few years ago, then you don't want to mess with that. But if you can get a fixed, do it. I'm a big fan of leveraging your primary residence because you can get the cheapest money that way. You can get, it's your primary. So banks are happy to lend for cheap. That's how Rich and I got started. We refied, took cash out of our house in Lafayette, California. Prices had gone up like $100,000 a year. We had just a ton of equity. That equity is sitting there doing nothing. So we borrowed against it. I think at 6% then. Now you can get it for much less. And we bought, I don't know, like 8 properties in Texas and in like half a year. And then those properties had high cash flow. They ended up increasing in value. We were borrowing money at 4%. We were probably getting returns of 20%, all said with appreciation and cash flow. So, and tax benefits. I think we paid 0 tax that year because we bought so many properties all at once. So am I a fan of it? Heck yeah, if you do it right. It's your home equity, so don't be flippant with it. Don't just buy a property online and not check it out or do your due diligence. Make sure you buy the right property in the right neighborhood and the path of progress, near good schools, near jobs. That's, in my opinion, been already renovated. You can inspect it. You know what you're getting. With all those things in place, absolutely. If you think you can get a better return than the 4% you'll be borrowing for, or 5%, then why would you not? Yeah, it makes sense to me. Okay. Where is the best place for appreciation? Like I said, I have this beautiful slide. If you go on our website and look at my 2019 housing predictions, the slide is on there. And it's basically from John Burns' Real Estate Investing. And he shows where all the job growth is headed for the next 10 years and the population growth along with it. It is headed to the southeast massively. So again, Albuquerque, Texas, Florida, that's where the masses are going. So that's where we expect to see appreciation. But we're also seeing appreciation in the markets that no one expected except us, because it's not really appreciation. It's just that you're getting houses for cheap and they're just bouncing back to their normal prices. And that would be Ohio and, Cleveland, Cincinnati, Detroit. We've seen great appreciation there, but it's not normal. It's just that we're still able to get properties for so little. Okay, next question. What's a good source for finding information in an area for due diligence? Very good question. I would say first and foremost, go to our website because we compile so much of it. You just go to the single family rental. It's the Invest tab. And if you click on the Invest tab, then you'll see, you have to log in first. You'll see all the markets and just an enormous amount of data on those markets that we have gathered from many, many sources. So I think it's a great resource. From there, to dig in deeper into neighborhoods, you can go to citydata.com. That's just incredible. You can zoom in street-wide. Of course, Zillow and all those kinds of sites will tell you rental comps. You've got Rent-A-Meter for rental comps. You can look up crime. Although all of those things are truly better to do in person. If you want to know about crime in an area, you just walk down the street and talk to neighbors. They'll tell you more than the police department's going to tell you or any crime site. You just go to the neighborhood and ask around and they'll tell you everything you need to know. So anyway, those are some of the sources we use. What markets do you think is best to invest in right now? Like I said, I like all the markets on our website. For our turnkey rental fund, we have a fund where investors let us do the managing for them. And the way we handled it was diversification. So we bought a bunch of properties in growth markets like Florida and Texas, but they don't cash flow massively. So to balance that off, we bought a bunch of properties in Ohio and Michigan. And we kind of recommend that. So you get a few high cash flow, get a few appreciation. It sort of balances each other out, but in all reality, they've all appreciated all of those markets. Okay, so how can we earn $300 cash flow out of a $100,000 house based on what rent? So just, go look if you have spoken with our affiliates, you just kind of let them know what you're targeting. Rents, mortgage rates have gone down, so it's getting a little bit easier to target this. But low state income tax states will help you shoot for this. But even if you're getting closer to 200 a month in cash flow, it still works. You're not going to get that in the high appreciation markets, like I said, in Florida and Texas. So you have to understand there's a trade-off there. But if you're just shooting for cash flow, you can get that still in the cash flow markets. But you don't expect to, be in a, like I said, in Dallas and get high cash flow and appreciation. It's just you got to choose one or the other. But like I said, it's been kind of fascinating that in the super high cash flow markets, we've seen appreciation as well. So if you really want that, you need to check out Ohio, Indianapolis, even in the Southeast, in Alabama, there's been some pretty good cash flow plays there. How much reserves needed for repairs? We like to say about 8% of rent set aside, 6 to 8% of rents set aside for reserves. Some people say just write a $5,000, $5,000 or $10,000 check to your bank account and leave it in there for emergencies. Some people say 6 to 12 months of your rental income in reserves. Just know that vacancies do happen, repairs are needed, and you need to have that money set aside. Just like any business, you wouldn't run a business with zero money set aside for whatever, things happen. So this is a business and you need money set aside so that you're not stressing it when those things happen, because I guarantee you they do happen. Go through your whole website and ask questions before talking to the investment advisor. That would be amazing, but there's hours and hours of content. So no, you don't have to do that. Just listen to our, first of all, I have my book, Retire Rich with Rentals. That is a very quick way. I've heard people say they've read it on one plane ride, one afternoon. I've had teenagers say they read it very quickly. It's a great sort of summary of how to get started. I'm not just trying to plug myself. I really wanted to boil it down into one place. Retire Rich with Rentals will give you that. We also have a checklist under resources on our website that will help you understand the things you need to do. There are lots of webinars if you just want to understand lending better, if you want to understand asset protection better, whatever the topic is. If you go to the Learn tab, you can find those resources. So I don't expect you to take a week off and go through everything all day long, but get the basics, the things that you're most concerned about, read the book, and then talk to your investment counselor. When you sign up to talk with one of our investment counselors, there are some webinars that we do ask you to listen to beforehand that will make the time with your investment counselor much more valuable. So you would get links to that when you sign up. Okay. When will this webinar be available? It will be available quite soon. Our team is awesome. They will edit it and have it posted probably by tomorrow, but if not, just in a few days. Thoughts about Central Florida and Jacksonville quads. Those are probably my favorite right now. Central Florida is the #1 fastest growing places in the country. So yes to all of that. And Jacksonville as well. I'm a big fan of the property manager, of the team, of the quality of the builds. You can get one loan on a 4-unit. They go quickly. They're hard to get, but I think we've got the webinar next week. But anytime you're interested in a market and you know that there's a webinar coming, I would probably reach out to the affiliate beforehand, because they will probably sell out after the webinar. So, you might want to reach out beforehand if you're interested in that area. But I'll tell you what, a quick search will tell you that Central Florida, Orlando, Tampa, that whole area, Jacksonville isn't necessarily Central Florida, but it's in that region. It is the fastest area growing with jobs and population in the entire country. What city should I start with? It's a really good question. If there's any way you can come to our Ohio event in August, you'll get to meet all the affiliates. You'll get to kind of see, you have to understand you're going to be in a long-term relationship with this affiliate, with your property manager, because it's buy and hold. You're holding for a long time. So you're business partners basically with your property manager. So To me, that's kind of the most important thing, is to decide who you like, who you feel like you can get along with, and who you trust. Once you've decided that and you've kind of looked at the data and the metrics, and go out and see and the properties, meet the team, you'll know. You'll know which team seems like the right match for you. Are property managers vetted by RWN? I mean, vetted is a big loaded word. So what I can tell you is that we have asked them our 20 questions that we ask property managers. You can get that property management questionnaire on our website. We would never have any affiliate on our website or at our events or recommended if they weren't doing the job, right? You know, if we're getting complaints, let me tell you, that's the leverage we have. They no longer get referrals from our team. So we are not there. We don't own the companies. We're not a part of them. Things can happen. There can be a changeover of staff. So all we can do is look at history and know that they've had a track record and that our members are happy, and that we've looked into them, we've done the background checks and all that. But you're the one who's, what if they changed contracts and we haven't seen that, and you look at the contract and say, I don't know about this. You're the one who has to look through it. You're the one who has to check and see, wow, they haven't been very communicative with me. I'm not sure, I like working with them. So even though they come highly recommended to us, at the end of the day, it's really up to you to make sure that they're working for you. Here's a great question. Do you run into couples in which one spouse is ready to pull the trigger on investing in property and the other is wary? What has been the most effective means of convincing the wary spouse that this is the right way to invest? Yes. That's the way it goes. Most couples are totally opposite. Most people are attracted to their opposite, right? So the things we love about our spouse are the things that drive us the most crazy. And so when we can begin to respect our differences, that's when things start to work. So in the beginning, I was the person who was like, let's do this. And Rich was like, I don't know. I need more information. So I had more information than he did, and that was the problem. So if you have a spouse who's wary, chances are they just don't have the information that they need to feel better. So find out, because it's very possible that the person who's ready to pull the trigger hasn't asked all the right questions yet. And Rich and I have learned to listen to each other. Even just a couple of days ago, he had a bad feeling about something, and I was like, man, you're stressing out about nothing. And then I stopped being judgmental and decided to find out what he was stressing out about and asking lots of questions. And it turns out he was completely right, and we needed to look into this further. We ran it by our attorney. The attorney agreed completely with what Rich was saying, and it's like, man, I would have overlooked it. So we have found that we are such great allies and resources for each other because we both have different skill sets. Now, if it were him, he probably wouldn't have pulled the trigger on a whole bunch of things. So I help him move forward. He helps slow me down, and it really works. So just find out from your spouse what they're concerned about and get them the information they need. If they're concerned about asset protection, set up a call with an asset protection attorney. If they're concerned about, the market crashing, watch one of my economic webinars with them and find out that then you could say, wow, there's more risk in not doing anything, So usually when somebody is nervous, they just need information, and that's all. I had a couple come into my office 10 years ago or so, good friends of ours, and the husband knew that real estate had hit bottom and that it was the time to buy. But let me tell you, every headline was saying that it was the worst thing in the world to do to buy real estate. So they came into my office, and she just burst out in tears. She was so scared to lose money and so scared to make the wrong decision. And so I said, look, she just needs more information. She needs to go see the property. She needs to go visit this. I think it was Dallas that she needed to go check out. And he goes, you know what? I'm going to send her there by herself so that I'm not there to influence or be annoying. I'm going to, give her the list of questions. And she went by herself on this trip, looked at all the properties, and came back with 5, far more than he ever would have bought, because she was satisfied with the responses. So There you go. All right. I have filled out the RWN to connect with an advisor. Uh, what do I do now? I haven't heard back. You know what? If you could just send an email, we have a chat on our screen, or info@realwealthnetwork.com, or Kathy Fettke at realwealthnetwork.com. We'll make sure that I'm not sure what happened. Usually you have to pick your time with the counselor. So if that hasn't happened, just please reach out, info@realwealthnetwork.com, or the chat feature on our website. As a new investor, what aspects should I consider to maximize my investment, assuming that I buy in an up-and-coming market, Florida, Detroit, Cleveland, or Texas? I'm not really sure the question. Let me read it again. As a new investor, what aspects should I consider to maximize my investment in an up-and-coming market? Well, I think you nailed it. An up-and-coming market would be the key. You want to be in an area where you know that there is growth planned, that maybe the city or the county or the state is putting in some new infrastructure, maybe a new freeway, maybe jobs are going there, maybe new schools, something exciting is happening. I don't like buying in boring areas. Some people like boring cash flow. I don't. I want to be where the excitement is. I want to be where the jobs are going. So you want to make sure you really understand that data. And like I said, city data is really great for that. You can really hone in on the market and see what's happening, how much people are making, if they've had raises over the past year or so. You could talk to the property managers and say, hey, where's the rental demand? Have you seen rents going up? What's new and exciting in this area? I mean, all of the markets we're in, we only want to be in the neighborhoods where there's growth. It's like, it makes no sense to go to the part of Dallas where the jobs are not going. We know a lot of jobs are going north. I want to be north where the jobs are. So just because we say an area is good doesn't mean that every neighborhood is good. So just really get clear with the property manager if the area you're looking at is in high demand, and if you're seeing rents go up, make sure you verify that the city or the county is indeed investing in those areas, because you need more than yourself. You need a big push behind whatever it is you're trying to do. Opportunity zones, if you're buying in an area that's near an opportunity zone, we know that there's trillions of dollars pouring into those markets, and we expect that values will rise, and most of our affiliates are experts in those areas. So whether you're going in to get the tax breaks or you're going in for the appreciation, either way, that's our affiliates that's their expertise. That's the neighborhoods they've been in forever. So what I love about our affiliates is they are investors themselves. They're obsessed with real estate like I am, and they know where the deals are. They know where the growth is. They want their clients to be happy. They want to know that they're not going to get complaints and the properties are going to stay rented. So, they're not going to put you in some area that is not doing anything, but you still need to verify it. Okay, if I don't have a lot of income but have cash, would you suggest buying with cash rather than waiting for income to go up? If you have a lot of cash, sure. I mean, some of these properties like in Detroit are, cheap. They're like under $70,000. So if you buy with cash, you could potentially get a loan in 6 months, and you might be able to use the rental income from the properties to help you qualify for those loans. And there are many lenders who are asset-based, so they would just lend because the asset has value and they're not so much looking at your income. The rates are going to be a little higher than conventional, but certainly talk to a lender, one of our preferred lenders, and they can kind of tell you what to do and if there's a possibility of you getting loans at some point. Though you recommend taking 30-year fixed loans when analyzing for cash flow before purchase, do you use 30 years or 15? I like the 30-year fixed rate payment. I look at the cash flow based on that, and then I would take the cash flow to pay off the loan if you're trying to accelerate the payoff. Rich and I aren't as much trying to accelerate that payoff. We just like the cash flow, so we're not paying it off in 15. The 15-year plan is more like if your goal is to pay off the loans and live off the cash flow. If you are looking more long-term, then you might want to take all that cash flow and just keep acquiring, if you're young and want to keep acquiring. Yes, this presentation will be available online. How do we get houses? Do you just buy off the MLS? We have 15 affiliates, boots on the street in the different markets, who have a zillion different ways of finding property. 10 years ago, it was different. 5 years ago, it was different. People were buying at auctions. There were so many distressed sales. Markets change, and as markets change, the way you acquire property changes as well. So now the MLS isn't necessarily the best place, but sometimes they do find them that way. But more often, they are finding distressed sellers who need to sell quickly and will, take a lower amount so that our affiliates can fix up the properties and still make it below market value for our members. What are some good advice you can give to first-time property investors in terms of a loan? Is there any special loan rates for first-time homeowner? If you are buying your own home somewhere, then yeah, there are some great loans for you with just 3% down. If you're dating an FHA loan, you could get just 3.5% down on a fourplex even. Live in one unit and rent out the other three. Nobody says you have to live there forever. Generally, the intention is supposed to be that you live there, but if you got to move in a year and just rent the whole thing out, then, again, you just have to prove that your intention was to live there. If you live in an expensive market, it's going to be really tough to find a good deal. But you can do what a lot of our members do, a lot of even our staff has done, which is, let's say you have the chance to work remotely. Maybe you just go live in a market for a little while that's a good potential rental market. You live there as a primary residence and then are able to rent it out later and move back wherever you need to move back. That's one way, but as far as investment property, no, you don't get any special treatment being a first-time investor. It's 20% down. Investor loan, we all get the same treatment there. After 4, it's usually 25% down, depends. How do you use a hard money lender to purchase, buy, and hold, and what kind of exit strategy can you use? I don't know any you wouldn't want a hard money loan for long-term hold. I think the only reason you'd want a hard money loan is if you've already qualified for a good loan, but you just need to acquire the property. Maybe you want to fix it up with the hard money. Now you've increased the value and you want to refi, get all your cash back, pay back the hard money lender, but now you're in a low loan. But most hard money lenders just are in it for the short term, and you wouldn't want to pay them what they want too high. You want cash flow. Are the list prices your partner's list negotiable? Usually not. These guys are struggling. Our affiliates are really struggling to find deals. Inventory levels are low. They are barely making a margin. They're barely making any money. Very rarely can they discount the property. What I think is fascinating is they don't increase the values. I've got one of our affiliates has 90 people on the wait list. Now, we don't like that. It's not a great situation for our members, but she's just so popular. But you know what? She doesn't do what most people would do, which is say, all right, I'll take the highest bidder. No. It's like we keep these prices where they need to be for cash flow. We're not raising them, but we're not able to lower them either because the margins are just so slim right now. It's so hard to get property. Is CapEx and repairs maintenance the same thing? Yeah, pretty much. How much should you account for? It just depends on what you're buying. If you're buying a property off the MLS, you don't know what condition it's in, then you need to set aside a lot of money for whatever repairs may come. If you're buying a property that's already been renovated, your maintenance and repairs fees should be lower, especially if it meets our standards, our real property standards, which you can find on our website. What do I think about Vegas and Nevada? You're going to have a harder time cash flowing because prices have gone up so much, but these areas are growing. So if you don't mind taking a hit on cash flow, it's more speculative, but we do know lots of Californians are moving to Vegas and Nevada. We don't have teams there because the cash flow is just not that great. I need to sell my San Jose home under 1031 exchange and buy multiple homes in Florida. Can your team help with that? Absolutely. We have some awesome 1031 exchange companies under our resources tab. That's probably one of Real Wealth Network's greatest strengths is helping people in a 1031 exchange, because how on earth could you sell a property here for $1 million and go out and meet the deadlines of 45 days and find the replacement property? I mean, it's just so hard to do. But if you work with, we have 15 teams, they're going to be able to find you something, especially if you give them enough warning. So if you know you're putting your property on the market, you reach out, have your strategy session, pick your markets, hopefully go out there, meet the teams, get everything set up and in place so that you're ready to go and you know who you want to work with and they have set aside property for you. It's going to be so seamless. You'll be blown away. We have so many people just really, really extremely thankful for the way we've been able to help them with such a difficult thing. Selling an expensive Bay Area property. But what they find is they have dramatically increased their cash flow when they do the 1031 and diversified risk. And yeah, it's great. And oftentimes gotten into much newer properties than the one they owned. So there's less maintenance. Under the 10 property purchase model, do you recommend all properties in the same location? No, I think it's better to diversify. Like I said, I'd rather you get a bunch in growth markets and then to offset the lower cash flow, get some high cash flow properties. I like diversification. Some people like maybe 5 properties in each market, maybe 3 markets with 3 or 4 properties. If you just absolutely love a market, we have plenty of people who do that too. They just buy everything in one market. But again, I prefer diversification. I'd probably choose 2 markets. Isn't it hard to get a property with 3% down? Not today. You shouldn't have a problem. If you're pre-qualified, those loans are done every day for a primary only. If you're trying to get a property that's an awesome, amazing deal, it is not a strong offer. But if you're trying to get a property that maybe has been sitting on the market for a little while, needs a little work, or is just a good deal, you shouldn't have a problem. What do I think about North Carolina? I've always loved North Carolina. It's a growing market, but unfortunately, kind of like Austin, we've just not been able to find great cash flow. We just think there's some markets that have better cash flow and growth potential. And do we accept 1031s in our syndication? We're so frustrated that we are not able to. You're not allowed to, that you have to exchange into like kind. So exchanging into a syndication, the IRS doesn't allow. We've tried to find some workarounds. We haven't found one yet. So at this time, you cannot do a 1031 exchange into our fund. My apologies. Okay, we are past the hour. Wow, thank you so much for your wonderful questions. I think we're going to do more of these. I'll do another webinar on my favorite markets. And again, if you're interested in learning more about real estate, you can contact your investment counselor or get an investment counselor by going to realwealthnetwork.com/connect. And then, it's hello at Real Wealth Network. If you have questions, it's hello at. So I gave you a couple of other ones. Those are not the ones. It's hello at. We have the most wonderful team of people that are ready to take your call. All right. Thanks so much, everybody. Have a wonderful rest of your day, and we'll talk to you soon. Bye-bye.